Hey everyone, this is Ed Kime, CEO over at Quantcha, and in this week's video, we're going to talk a bit about synthetic longs. And from there, we're going to jump into forward prices and option break-evens. Let's just jump right in and talk a bit about what a synthetic long position is. A lot of people have heard of these. You may have opened them yourself, or maybe you're considering it. And let's just talk about how you would structure a trade like that. Now, the idea behind a synthetic long is that it is a long position in the stock effectively, but it's constructed synthetically using options. So when you open a synthetic long position, you don't actually own the stock and you're not short the stock. Instead, you own options, both long and short, for that stock. Now, typically for a synthetic long, what you'll do is you'll buy a call or some quantity of calls, which are generally at or near the money. For the example we're using here, we've got pricing for Facebook's $80.50 calls expiring next week. It's a weekly option on May 1st, and the call is currently available at $1.63, which is the ask for the call. So if we're buying it, let's assume for now we would pay the ask. Now, what you do is you can see the typical call position that you'd have here where you have a complete loss at that $80.50 and you sort of work your way back up for that $1.63 premium until you finally start having a profit a little over $82 a share. Now, at the same time, what you do is you sell a put and you use the same strike as for the call. And in this case, the weekly $80.50 strike for Facebook is offering 58 cents a share. That's the bid we're working with here. So you'll notice this has a typical. This is just a standard put option, and of course you're maximizing your profit if the stock closes at or above the strike being $80.50, and you're sort of trailing off if the stock closes below that. Now, when you combine the two of those, you end up with this synthetic long position, which basically follows the same payoff as a long stock position. In this case, you'll notice it's one continuous line that sort of crosses the break even at $80.50. In this case, actually, I should change that. It doesn't break even at $80.50. 80.50 is the strike where we're constructing this, but based on the premium, in this case, it's costing $1.05 because you're subtracting the money you receive from selling the put from the money it costs to buy the call. And so you'll have to actually reach, in this case, because it's $80.50 for the strike, you're looking at $81.55 as the break even for this particular position. Now, another thing to talk about here, just as a close cousin here, is something called a risk reversal. And a lot of people have heard of those or maybe constructed them as well. It's the same concept, except when you sell the put, you're selling it at a lower strike than the call. And there's a variety of reasons when you might want to do this. One of which is the fact that it actually sort of lowers your risk profile a bit, because in the case here, this risk reversal that we're modeling out here has a long call at 81.50 and a short put at 79.50. And so what that means is that you don't really start losing a significant amount of money until that call kicks in. In the meantime, it's really all premium that you're losing until you reach that put. And so that's sort of a close cousin that you might be interested in depending on the position you're in. Now, the synthetic long concept is actually important related to other aspects of investing because there's a concept of being hard to borrow. And this is something that anybody who's tried to short a stock needs to be aware of. When you short a stock, what you're doing is you're borrowing it from one person to sell to another. And you're kind of on the hook for how that stock, for being able to produce that stock for the person you're borrowing it from. And there are some natural limitations to how easy it is to borrow stock because not many people who own the stock are willing to loan it out because they might be concerned about the pessimism around the stock and want to sell it themselves to get out of it. So, when a critical mass of investors becomes so pessimistic about a stock and they're shorting it so heavily that it actually becomes hard to borrow for others to short, meaning that people can't borrow the stock because it's just not available or people aren't willing to loan it out. So when that case happens, what you end up seeing is that investors will turn to going long puts or short calls. And that impacts the demand because now you have a lot of people who either want to buy puts or they want to sell calls because they're so sure that the stock is going down. As a result, the put prices will get inflated and sometimes the call prices will get deflated. And depending on how the extreme of this happens, ordinarily what you see is when you're dealing with things around the money, the calls will be at a slight premium to the puts because in general people are a little more optimistic about the future of most companies. Now, when there is a 10+% discount on a stock for a duration, the Quantcha tools identify that and consider it to be hard to borrow. You might notice that if you're looking at certain stocks that we put up a little warning or a little banner across the top that says that the stock appears to be hard to borrow. We're taking that and saying it appears based on the pricing of the stock. We're not actually pulling that from anywhere. What we're just saying, when you get to the point where there's such a significant premium for the puts, that it's most likely that the stock is hard to borrow. Here's an example of recently of BP Prudhoe Bay, where the stock was trading at $69 a share, or right around 69, and the 70 calls and puts being the closest to the money. The 70 calls were available where you could buy them. The ask for them was $3.30 a share, whereas the puts at the money were offering $12.40 a share, and that's the bid for them. So if at the time you could open a market position on this very quickly, and you'd end up with a credit of $9.10 per share for a stock that was trading at $69 a share. Now, if you take that concept and you take a look at what the profit and loss chart. Here's your payoff diagram, and you notice it's a synthetic long. I mean, this is a typical trade that we were just talking about. But the one thing to catch is that the at the money price, or where the stock's actually trading, is at $69. Now, it's not uncommon for a stock when you open up a synthetic long position. If you open it up where the put is already in the money, then it's not uncommon for you to get a premium, because obviously when you're selling, if you're going to sell this put at 70, it's already a dollar in the money as it is, and the call being out of the money by a dollar is going to get a little bit of a discount as well. But this significant discount with this price, you can see that if you're willing to buy this position and simply hold it till September, if the stock didn't move at all, it would be profitable immediately. And you could see really down into the 61 and less range, you'd be able to make a profit on a trade like that. Now, of course, the thing to be careful about is when a stock is hard to borrow, it's because a lot of people are pessimistic about it. And so you really have to do your due diligence, and you really have to be confident that this particular stock is something that you see for the long term. And if you check out our ideas blog, we actually have a scanner that watches out for hard to borrow opportunities throughout the trading day and posts ideas on them when they're noticed. Now, we've actually put in a few features around this stuff. We've had the hard to borrow stuff for a long time. Over the past week, we've added some neat things that help you model the range you're looking for when you're modeling the outcome of potential option positions. So in the case of forward price, this is a price which is basically where the at the money synthetic long breaks even. So in the case of a stock, like we were talking about before, with the Facebook stock, the idea of saying if you were to enter the synthetic long at the money, where you would break even is sort of like the tension point between the people that are trading the puts and the calls, have sort of decided that there's that sort of point of stasis, or that equilibrium that says the demand is not pushing the stock to go higher or lower than that based on what people are willing to buy and sell. And a close cousin of that is the concept of option break-evens. And we've added the data for the option break-evens for puts, calls, and for all of them. And we've weighted them by open interest to give you a specific number for an expiration that helps you meaningfully understand what it means. And I'll show you that in 1 second in the UI, so don't worry about the dense slide here. But the content is pretty simple. The concept of a call break-even is to say if you take the strike of the stock, or rather of the option, and you add the premium it costs for you to buy into that option, or what it's currently trading at, that gives you a break-even point. So for example, if the strike is $100 a share and the premium is $10 a share, then somebody who made that trade recently, the person who was going long, thinks that the stock has a good likelihood of going above 110 a share, because that's how they're going to profit from that trade. And at the same time, there was someone who's equally self-interested who said that they think that the stock will stay under 110 a share. So the interesting concept behind the call break even is it's not so much a bullish or a bearish concept, but it's more saying in the event of the bull scenario playing out, where does the market kind of find an equilibrium as to how far the stock should go or not go up. And so you could sort of either look at it and say the stock will go above this 110 point, or the stock will go up but it won't reach this 110 point, because we're weighting them by open interest. And the open interest weighting tells you that if someone is holding an option, and let's say they're very confident that the option is not going to be profitable for them to hold, they're likely to sell to get out of the position before it gets worse for them. And so open interest is a nice indicator to help you understand how much weight is being put behind any given position. Now, on the flip side, and this is actually an error in the slide we have here, for the puts, it's actually the strike minus the premium. And so, if you were to take a given strike at 100 and take a $10 put that you buy, then the stock would have to go be below $90 a share in order for you to profit from that. And the person who is selling that put is likely to be of the position that the stock should end above $90 a share. And so they're sort of looking at this from the perspective of, I'm trying to protect myself, and I think I can make money because the stock won't go below that. So that's just a couple key concepts there. I'm going to switch over to the option search engine now. And here we are on the dashboard, and we're going to take a look at Facebook. And we're just going to look at Facebook for the 5-day expiration from today, which is May 1st, which is this coming Friday. And if we take a look at the stock, what we can see here is this is expanded out already for us. The layout is a little bit different for our modeling view. One thing is we changed the name to model, which is a little more accurate than forecast, because we're not proposing anything. We're just trying to give you all the data you can need to make a good decision about where you think the stock is going. And you notice we changed the lineup a little bit. We're trying to make this a little more efficient because there's just so much data. But it's really valuable data to get this visual option chain that we have in place. Now, the key things we talked about, first one, implied volatility, we've talked about in the past, but forward price is here. So this tells you that this 81.55 is basically where the at the money synthetic long would break even. And the reason that's important is because if this number happens to be a huge negative, because the stock is hard to borrow or approaching being hard to borrow, you're going to see the forward price be significantly lower. And we'll take a look at an example of that in a minute. But right now, the fact that the forward price is right around where the stock is trading right now is a pretty good sign of the option market kind of identifying that over the next few days, and of course this is just a weekly trade from today, that there isn't too much confidence of a big movement in either, or a big movement in any given direction. And so people are basically trading it fairly even-handedly. Now, the break-evens is another interesting set of information. The put break-even basically says if you take all these puts that we have, and even the ones that are off the edge of the current view, and you were to take their strike prices and subtract the premiums and then weight them by open interest, and if we pull out the volume, all the other stuff, you can see this is the open interest. This is where it would have to break even for the puts on in general as a mean to be profitable. So there's sort of confidence that at this point you could say arguably that the market thinks that by the end of the week the stock is likely to go, if it goes down, it's likely to go down to about this point and not necessarily below it or not necessarily above it, but that's kind of where the point of equilibrium is at this stage. And the break even for all is basically the combined put and call. So if we see call on the other end, the call break even indicates about a 3.67% move upward, and the put break even about 3.4% downward. So that's kind of an interesting view. It sort of sees a lot of balance. There was an earnings call recently, and so this is kind of the point where I guess everyone's sort of evaluating where the stock is and where it's likely to be. And this all break even being a slight edge upward, you may or may not read into that as you want to. If we were to move out, let's say just some arbitrary amount of time, I mean, now this is a few months down the road, you can see that the movement in this time frame being for the July time frame about 2 months out, or rather 3 months out, the call is about 8.5% up, the put a little less than 6% down, and the break and the all combined, just which is it's not an average of the call and the put, it's all of these being weighted equally. So in this case, it looks like there's probably about maybe 3-to-1 calls over puts, in which case, or maybe it's about 2-to-1. But the point is, that just means that all of these things are being counted individually, and it's not just an average between those two. But that's some good stuff to know. If we move over to Twitter, and I'm going to use Twitter as an example here, and I'm actually going to move back into the most recent, not trading for that week, I guess, to the most recent one. As you can see, there's actually an earnings call coming up before this stock before the end of this week. So even though we're looking at the weekly right now, you can see the put break even number and the call break even numbers. The movement is pretty wild. So there's expectation of a ton of movement. And you can see the volatility itself is also way up. Now, these are some cool indicators because the implied volatility and the put call break evens, those both are indicating a huge swing potential for the stock this week, but they're kind of independent. They aren't necessarily directly related because the pricing that's involved and the work that's done here to calculate these numbers is more or less independent of the volatility, because the volatility is more about the general pricing and how the pricing can be explained by the how it can be explained by the exact prices based on the amount of time, the volatility, and so forth. Whereas these are more direct market empirical numbers as to exactly what people are buying and selling right now. And so you can see a lot of interesting stuff there, and you can make your call based on how you want to trade that. And if we go out to the BP example that we used earlier, I'm just going to go up here and say for the BP Prudhoe Bay, and I think we were looking at the September expiration, was hard to borrow. At least you can see it's hard to borrow for the duration. If you take a look at the put break even, the all the break even, and the call, I mean the forward price here is $60.90. People are really heavy on the puts right now. You can see overall looks like there's a lot more puts. We will be adding in put to call ratio and a couple other smaller numbers like that in the not too distant future. But this is just giving you some good insight and just more ammo. So as you're modeling where you think the stock's going to go, you'll have access to it. So that was a quick update that's actually went a lot longer than I had anticipated, but hope you guys are enjoying the new features. We're going to keep going heads down. Thanks for all the feedback. And of course, if you want to get in touch with us, either hit us up at hello@quantcha.com or leave a comment down in the comment section. Thanks and happy trading.